Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, and today we have a really fascinating topic to dig into.
We really do. So Alphabet, the parent company of Google,
Right.
they practically print money. I mean, they have a virtual monopoly on internet search. They generate tens of billions in free cash flow. And they basically operate one of the most profitable business models in human history.
Oh, absolutely. Historically, yes.
So, as a beginner, navigating the current economic landscape under the Trump administration, you might be trying to figure out where to put your money.
Right. It's a tricky environment right now.
Exactly. And so you might be wondering why a company with a financial engine like Alphabet just woke up on June 1st, 2026, and asked the stock market for $80 billion.
It is a staggering amount of money. And honestly, it fundamentally changes how we need to view big tech moving forward.
Because asking the market for money, doing a capital raise like this, it's what cash-strapped startups usually do, not highly profitable giants.
Exactly. We are watching a company transition from this really high margin software-based business into basically a heavy industry infrastructure company.
Uh-huh.
And it's all in the name of artificial intelligence.
Which is wild. So our mission today in this deep dive is to explore the mechanics behind this massive $80 billion equity raise.
Right.
We're going to look at the physical reality of building AI and why this signals the end of the golden era of cheap tech monopolies.
It really is the end of an era.
So let's start with the actual structure of this capital raise, because before we figure out why they need the money, we need to look at how they're getting it.
Yeah, that's crucial.
Because the moment they announced they were creating new shares to sell to investors, the stock market threw an absolute fit.
Oh, the reaction was immediate. Looking at the data from June 3rd, 2026, we saw Alphabet shares drop almost 4% right out of the gate.
Wow, just instantly.
Yeah. GOGL dropped to about $361, and GOG dropped to around $358. To understand why investors panicked like that, we have to dissect how Alphabet is actually pulling this money out of the market.
Okay, so how are they doing it?
According to official announcements, they broke the $80 billion down into three distinct buckets.
Okay, three buckets.
The first is a $30 billion public offering, but they actually split that one right down the middle.
Uh-huh.
So $15 billion in standard common stock and $15 billion in something called mandatory convertible preferred stock.
Okay, wait, I want to pause on that preferred stock piece because that sounds like Wall Street jargon designed to confuse people.
It definitely does.
If I'm understanding the mechanics correctly, preferred stock usually acts a bit like a bond, right? Like it pays a fixed dividend to the investor.
Yes, exactly. It's safer.
But the mandatory convertible part,
Yeah.
that means these investors don't get to hold on to that safe dividend forever. By a specific legal date, they are basically forced to convert those preferred shares into regular common stock, taking on the exact same risk as everyday shareholders.
You've nailed the mechanism. Alphabet is, they're using this as a sweetener.
A sweetener.
Yeah. They know that dumping $30 billion in regular stock onto the market all at once would just crash the price.
Oh, sure. Supply and demand.
Exactly. So by offering this mandatory convertible preferred stock, they attract large institutional investors who want the safety of that guaranteed dividend for the first few years.
So it delays the immediate shock to the stock price.
Precisely. But eventually those shares do convert,
Yeah.
and the total number of common shares inflates anyway.
Which leads right into the second bucket, I'm guessing.
Yes. The $40 billion at the market, or ATM program, which starts in the third quarter of 2026.
Okay, so for our listeners, an ATM program isn't them taking a giant bag of shares and just selling it all on a Tuesday.
No, not at all.
It's more like a strategic reservoir, right? Alphabet sets up a legal framework allowing them to kind of drip feed shares into the open market gradually over months or even years.
Exactly, yeah. They only tap into it when the stock price is favorable, or when they specifically need to pay a contractor for a new data center.
Right. So it gives management total control over the valve.
It does, but, even with that careful management, the market still punished the stock. Investors are wrestling with this serious contradiction right now.
What contradiction?
Well, everyone agrees that artificial intelligence is the next major technological frontier.
Right. It's all anyone talks about.
Exactly. Yet, when the company leading that charge actually asks for the capital to physically build it, shareholders riot.
It's crazy. But I think the underlying fear here is dilution.
Oh, absolutely.
Let's step away from Wall Street for a second to explain this. Imagine You own 10% of a wildly successful local lemonade stand.
Okay, a lemonade stand.
Right. The stand has zero overhead, and it makes incredible profits. But then the other owners decide they want to build an experimental $50 million commercial lemon farm across town.
That's a big jump.
Right. So to fund it, they issue a bunch of new ownership shares to outside investors. Now, your stake in the business suddenly shrinks from 10% down to, say, 7%.
Right.
Even if that lemon farm might be profitable in a decade, your slice of the pie is permanently smaller today.
That is the perfect analogy. Dilution is that immediate mathematical hit to your portfolio. But the anxiety actually goes much deeper than just a smaller slice of the pie.
Really? How so?
Well, for years, Alphabet has operated with a mechanical safety net for its stock price, the share buyback.
Oh, right.
When a company uses its profits to buy its own shares off the open market and then destroys them, it artificially reduces the supply of shares.
Which drives up the price.
Exactly. It drives up the earnings per share, or EPS. It makes the stock look highly valuable, even if the underlying business isn't growing exponentially. Just to give you an idea, between 2024 and 2025 alone, Alphabet spent $108 billion buying back its own stock.
Wow. $108 billion. So they spent years shrinking the pie to make everyone's slice bigger.
Yes.
And now they are abruptly throwing that strategy in reverse. They're abandoning the buyback model to print new shares instead.
Exactly. And that is a huge structural pivot.
But let's look at why it costs $80 billion in the first place.
Yeah.
Because I think a lot of people still think of AI as just, invisible code floating around in the cloud.
That's the biggest misconception out there right now.
Right. You type a prompt into Gemini and a smart answer just magically pops out. But recent analyses of Alphabet's 2026 capital expenditure guidance, which, by the way, sits at an eye-watering $180 billion to $190 billion,
It's just massive.
it reveals that AI is fundamentally a heavy physical industry.
The physical reality of artificial intelligence is definitely the biggest blind spot for casual investors today. When we talk about scaling Google Cloud, AI search, and all these autonomous AI agents, we aren't just talking about software updates. We are talking about real estate and heavy manufacturing.
Right. Real physical stuff.
To process these massive AI models, Alphabet literally has to acquire thousands of acres of land. They have to build concrete and steel data centers. But, the real bottleneck,
What is it?
power and cooling. Standard computer servers can be cooled with basic fans, but AI servers, which are packed with these specialized tensor processing units, or TPUs,
Good chips that make AI work.
right, they run so incredibly hot that they require massive liquid cooling infrastructure.
Liquid cooling,
Mhm.
meaning they are suddenly in the business of securing municipal water rights and negotiating gigawatt-level renewable energy contracts just to keep the machines from melting down.
Exactly. It's a complete fundamental shift in their business model.
It's wild. Think about the legacy software business like being a digital travel agent. You set up a website, you connect a buyer to an airline, and you take a cut.
Right. Low cost.
Yeah, it costs you almost nothing to maintain. What Alphabet is doing now is equivalent to that same travel agent suddenly deciding they need to buy and maintain their own physical fleet of Boeing 747s.
That's a great way to put it. Because the economics of a digital travel agent are beautiful, the marginal cost, the cost to serve one additional customer, is practically zero.
Right. Searching for a recipe on Google costs the company fractions of a cent.
Exactly. But the moment you ask an AI model to generate a custom meal plan, write a Python script, and synthesize a video, the computing power required spikes massively.
That's a totally different game.
It is. The historical barrier to entry in tech was simply having the smartest engineers and the best software algorithm.
And once you wrote the code, you pretty much dominated the market.
But today, the algorithm is no longer the primary moat. The new barrier to entry is entirely physical. It's all about who possesses the most electrical power and the most cooling capacity.
So the historically capital-light, infinite margin search business is suddenly chained to a highly capital-intensive reality.
Yeah, exactly.
But if they have to buy the proverbial airplanes and build the runways, that brings up a glaring corporate finance question for me.
Okay, what's that?
Why are they issuing equity, selling off pieces of the company instead of just taking out a loan? Because Alphabet's balance sheet is incredibly strong.
It is very strong.
Looking at their recent quarterly filings, their operating profit jumped 30% in the first quarter of 2026 alone.
Right.
They are sitting on a 36.1% profit margin. They even increased their dividend to 22 cents a share. They clearly have the cash flow to service debt.
They absolutely do.
And according to the data, they recently raised over $85 billion in debt over the last year, bringing their long-term debt to over $77 billion. So why the shift to equity?
Choosing equity over debt at this specific scale is a massive signaling mechanism to Wall Street. It tells us two very important things. First, this isn't just a temporary construction project. Building AI data centers is a multi-year, permanent structural cycle.
Okay.
But more importantly, it is a deliberate decision about risk distribution.
Let me test a theory on that risk distribution with you.
Sure, go ahead.
If I want to start a business and I take out a bank loan, I take on all the risk.
Right, it's on you.
If the business fails, I still owe the bank. But if it succeeds, I keep 100% of the profits. It's like using a credit card.
That makes sense.
But if I fund that business by selling equity to a partner, treating them like a cosigner, I don't owe the money if we go bankrupt.
Yeah.
But if we become billionaires, I have to split the profits with them forever.
Exactly. You share the upside and the downside.
So if Alphabet's leadership was absolutely 100% certain that this massive AI infrastructure was going to generate a guaranteed massive financial return, wouldn't they just use debt so they could keep all that upside?
That is the big question.
Doesn't issuing equity feel like a massive hedge? Like management is secretly saying, we have to build this to survive, but we aren't entirely sure when or if it will actually pay off. So we want shareholders to carry the risk.
Your deduction is spot on, and is exactly why the stock dropped. By issuing equity, Alphabet protects its bondholders.
Right.
It ensures the company doesn't drown in interest payments if the AI revolution takes longer to monetize than everyone expects.
Which is a real possibility.
Exactly. But it officially redefines the company's relationship with you, the shareholder.
Yeah.
You are no longer investing in a cash cow that exists primarily to return capital to you through stock buybacks.
Right, that era is over.
You are now funding an uncertain, incredibly expensive war of attrition against Microsoft, Amazon, and Meta.
Which makes the third part of this $80 billion package so incredibly fascinating to me.
Oh, you mean Berkshire Hathaway?
Yes, a massive $10 billion private placement of this new equity was bought by Berkshire Hathaway.
It's a huge move.
For any beginner following the markets, Berkshire, guided by Warren Buffett and increasingly driven by Greg Abel, is the ultimate beacon of conservative, value-driven investing.
They really are. They look for reliable, predictable cash flows.
Exactly. They don't gamble on experimental tech. Yet this move increases their stake in Alphabet by 49%, giving them a 1.3% ownership of the entire company.
And it creates a really fascinating psychological anchor for the market.
How so?
Well, when everyday investors see Berkshire pouring $10 billion into an AI infrastructure raise, the immediate assumption is that the greatest value investors in the world have finally bought into the AI hype.
Right. Buffett loves AI now.
Exactly.
But looking at the data, I don't think they are betting on AI at all.
Really? Why is that?
Well, if you look at Greg Abel's operational history at Berkshire, he loves utilities, he loves railroads, energy businesses with massive unbreachable moats that just throw off cash.
Right. Very stable industries.
I don't think Berkshire is buying into Alphabet because they think Gemini is going to achieve artificial general intelligence.
Yeah.
I think they are buying into Alphabet because Google Search, YouTube, Android, and Waymo create this impenetrable safety net.
That's a really interesting point.
They are betting that Alphabet's legacy ad business prints so much cash that they can afford to completely bungle the AI transition and still remain incredibly profitable.
And that distinction is vital. Venture capitalists buy pure AI startups hoping for a miracle. Berkshire is buying a dominant cash flow engine that just happens to have a free option on AI attached to it.
Right. It's a safety play, not a growth gamble.
Exactly. And it highlights a brutal truth about the current state of technology. The cost of competing in AI is now so high that only legacy monopolies can afford the entry ticket.
Wow.
If you don't already have a business generating tens of billions in free cash flow, you simply cannot afford the land, the power, and the liquid cooling required to train the next generation of models.
Which means this isn't just an Alphabet story. This isn't happening in a vacuum.
Not at all.
This $80 billion move sends a shockwave through the entire stock market, basically redefining who the actual winners of the AI boom are.
Yeah, it really shakes things up.
We are seeing constant rumors of massive capital moves from OpenAI and SpaceX, and recent analysis says Anthropic is prepping for an IPO.
Right, there's a ton of movement.
But the immediate undeniable winners aren't necessarily the companies building the chatbots, right? The winners are the hardware and infrastructure suppliers.
It is the reality of any massive capital expenditure cycle. When Alphabet announces they are spending $190 billion, that capital doesn't just disappear.
Like it goes somewhere.
It gets transferred directly to the balance sheets of their suppliers.
Like NVIDIA. We saw NVIDIA's market cap hit an astronomical $5.43 trillion in early June 2026, officially surpassing Alphabet.
Which is just incredible to think about.
But it's not just NVIDIA making the GPUs. It's the companies manufacturing those specialized liquid cooling systems we talked about.
Yeah.
It's TSMC fabricating the chips, SK Hynix providing the high bandwidth memory, Broadcom handling the networking equipment.
Exactly. It's the whole supply chain.
It reminds me of the oldest economic story in American history. During the gold rush, the people who consistently got rich weren't the miners gambling in the rivers looking for gold?
No, they usually went broke.
Right. The guaranteed wealth went to the merchants selling the denim jeans, the pickaxes, and the shovels.
The pick and shovel investment strategy remains the most reliable way to play a technological revolution. But, for the miners, the tech giants themselves, there is a looming threat that the market is just starting to price in.
What's the threat?
Well, AI researcher Gary Marcus has pointed out a pretty severe structural flaw in this entire arms race.
Okay.
All the hyperscalers, meaning Alphabet, Microsoft, Amazon, Meta, they are all buying the exact same hardware.
Right, from NVIDIA and TSMC.
Right, and they're doing it to build the exact same massive data centers to train very similar large language models on the exact same public internet data.
Oh, I see where this is going. If everyone has the exact same underlying infrastructure and essentially the same output, you don't have a unique product anymore.
No.
You have a commodity. And when you sell a commodity, the only way to win a customer is to lower your price.
Which inevitably triggers a brutal price war. And this is where investors need to focus on a metric called return on invested capital, or ROIC.
ROIC, okay.
It is totally meaningless to celebrate Alphabet spending $190 billion on data centers if we don't know the profit margin on the product those data centers eventually produce.
Right. If Alphabet has to drastically cut the subscription price of Gemini just to prevent users from switching to a Microsoft or Amazon alternative.
Their profit margins will collapse.
Exactly. Let's follow that logic to its natural conclusion then. Based on this research, if big tech companies are being forced to spend all their free cash flow to build massive physical power plants and secure vast tracts of land and lay down physical infrastructure just to provide a baseline commoditized service that everyone relies on, aren't they basically turning into public utility companies?
That's a really sharp observation.
Like, they aren't nimble tech companies anymore. They are the digital equivalent of your local water or electric provider.
The economic profile is becoming nearly identical. High capital expenditure, massive physical maintenance costs, and a huge reliance on vast natural resources.
But here's the problem for anyone holding these stocks in their retirement portfolio. Historically, software companies enjoyed astronomical stock valuations.
Yes, massive price-to-earnings multiples.
Right, because they had practically zero physical costs and infinite scale. But public utility companies trade at incredibly boring low multiples because their costs are so high and their growth is physically constrained.
Exactly.
If Alphabet and its peers are transforming into heavy industrial utilities, doesn't that mean those sky-high tech valuations have to come crashing down to earth to reflect this new lower margin reality?
They should, yes. But the market hasn't fully priced in that multiple compression yet. Investors are still evaluating these companies based on the economics of the 2010 software boom.
They're stuck in the past.
Right. They're ignoring the fact that the physics of the 2020s AI boom demand an industrial valuation. The companies that survive won't just need the smartest software engineers anymore.
What will they need?
They will need the most ruthless supply chain managers and the ability to severely temper shareholder expectations regarding profit margins.
Wow. So to summarize, Alphabet's $80 billion equity raise is a massive structural wake-up call.
It really is.
For you, the listener, trying to navigate this market, it means fundamentally throwing out the old playbook for evaluating tech stocks. The era of software growth at all costs, with infinite profit margins, is effectively over.
It's done.
The new era is heavy, it's physical, and it is wildly expensive. The most important question you can ask when evaluating a tech company today isn't how advanced is their AI. The real question you have to ask is, what is the tangible financial return on their massive physical investment?
Beautifully said. We are shifting from an environment that rewarded theoretical potential to an environment that demands concrete proof of profitability in a heavy industry landscape.
And as we wrap up this deep dive, I want to leave you with a final thought to ponder on your own, building on this concept of big tech becoming a digital utility.
Okay.
If the most powerful tech companies in the world are now effectively operating as heavy industrial giants, companies that require staggering amounts of the nation's physical land, vast quantities of fresh water for server cooling, and massive draws on the raw electrical grid.
It's a huge footprint.
It is. So how long will it be before governments step in? If they look and act like your local water and power companies, how long until lawmakers decide to start regulating them and legally capping their profit margins exactly like they do traditional utility companies?
That is a fascinating and very real possibility. It would change tech investing forever.
It really would. Well, that's all for today. Don't forget to subscribe and hit that like button.